Hey everyone, welcome to Modern Money Method. I want to show you today how to predict future mortgage rates. And it's not the way that they're teaching you in mainstream media. I want you to know that. And I also want you to know that a normal yield curve will be here again. These inverted yield curves generally do not last very long. This is a long time that this one is lasting. And it's actually a bad signal for the economy, just so you know. Generally, they only dip negative for a little while, and that's a bad signal. But 80-90% of the time, actually probably closer to 95% of the time, we have a normal yield curve, which is where as you go out in maturity on making loans, the interest rate charged is higher. Makes sense. You're going to loan your buddy money, you hand your buddy money for tomorrow, you'll probably be just fine if he hands it back to you. Give him $50, he gives you back 50 tomorrow. He wants to hold it for a year. You might want something more. He wants it for 10 years. You're going to go, dude, I don't want just my $50 back in 10 years. I want $100, whatever, you know. So the key is the federal funds rate. And so we're going to call the federal funds rate X. And we're going to leave my super high-tech chart here, which has been able to predict mortgage rates for the last 30 years of my life very accurately. I'm being facetious there. It's very simple, but it's not taught. So the federal funds rate is the key. And so we head over to the federal funds effective rate, and you can see it's not looking good. We were basically at 0, and now it's taking off like a sharp rising airplane. And a lot of people think the Fed is going to stop. They thought they were going to stop here. I don't know why. They announced back in November, December, Jerome Powell from the Fed, and said that there was going to be multiple interest rate hikes throughout 2022 and possibly 2023. So I took his word for that. And what I want to show you here is, although this looks bad, right? You might head over to the 5-year and go, oh, wow, look at this. Yes, we are near the peak. This chart right here shows this down like a bowl, and they're going to stop. No, you're only looking at a 5-year chart. This was already a weak effort here. This is unbelievable that we'd have interest rates at 0. We head to the 10-year chart, and now you start going, no, look, 0 or 2.5. He's going to stop. They're at 2.25 right now. I believe they're going to up 100 basis points this next week to 3.25, and I'll tell you a little bit later in the video where I think they'll start slowing down. You don't know where they're going to stop because they've got to look at indicators each month or two. But now let's head over to the max, and you can see this is just a blip. Guys, this is a blip. We have been in abnormal zone for 14 years. If you go back the 60 years before that, the lows were in the 1 and 2 range on the federal funds rate. And when fighting inflation in the 70s, it got up to 12 and even 17, 18%. This is the federal funds rate. Yes, I know this chart is hard to believe, but this is a possibility. I want you to know that. So if they have to keep rising interest rates to keep fighting inflation, 2.5, just because you look at this chart here and think, no, we're at the peak. No, we're at the bottom. So I want you to keep that in mind. Okay, so why this is important. I'm going to go back in time just a little bit here. We're going to go back to 2020. And what you're going to see here, the federal funds rate is basically can be kind of represented by the 1 month Treasury. And over here, I know we don't get to keep these column headings. We have the 10-year Treasury. So the 10-year Treasury is the third from the left. This is what most mortgage rates are linked to. I can make a whole video of why, but just accept it. Generally, because loans, mortgage loans, people looking to lend money and receive interest, they plan on trying to get it for 5 to 10 years. So a mortgage is more risky than a government treasury. And so this is a rate that interests people. Okay, what we're going to do here is we're going to hop down to when bad times hit. and the Fed came out and chopped this 1-month rate over here. They chopped it down fast right here over just a few days from 1.5% to basically 0, 0.12, 0.0. I want to show you what else happened. So here's the 10-year column right here, the third column from the right. Look at this. The rates on the 10-year got under 1, okay, during this time. And they even dipped a little bit lower and when the Fed funds rate was 0 here in the spring of 2020. You can see it over here, and you can see the 10-year was trading at 60 basis points, 70 basis points. I believe it even got down into the 50s. I don't know if it got much lower than that. There's a 58 basis point. So this is every day of the year. And we'll scroll on down here and see what we got. So yeah, here we're in the 50s again, and 60s in July. So remember, we are talking about the 10-year rate came down to under a point. Hung out a long time at 0.6, 0.7. Why does this matter? Because I'm going to show you what the mortgage rates were during the summer and fall of 2020. They were 2.8 right there, 3. They got all the way down to 2.67. I believe there were some people that got 2.5. You could pay a little money, get even less than that. But I want you to see right here, rates were in the high 2s, okay? It's very important because the 10-year was at 0.7, 0.8. So basically mortgage rates were about 2 points higher than what the 10-year was, okay? So what we're going to do is we're going to hop up here real quick and go to 2021. I just want to show you another little representation here. Interest rates on the Fed were still at 0, but inflation pressures were being recognized, and the 10-year started climbing. Here we have the 10-year. You can see that the 1 month is still down near at 0. The 10-year was at 1.2, 1.3. That's 1%, 1.3%. So just a little over 1%, 1.5, 1.6. Okay, let's hop back over to this chart. Why is this important? Well, because we go right here into the spring of 2021, and we had rates of 3.1, 3.2. So once again, the 30-year mortgage rate was approximately 2 percentage points higher than the 10-year yield, okay? So now you can spend a lot of time on this site if you want to. It's the treasury.gov. They show all the different treasuries. I didn't know they show them daily. So these are all treasuries you can invest in, your own money. But let's hop over to 2022 and apply this. And we're going to see why mortgage rates have been climbing so much. Do federal fund changes by the Fed change mortgage rates? Not directly, but indirectly, and I'll explain why. Because a normal yield curve looks something like this right here. So look at this. You have close to 0 on these short-term loans, right? And then as you go out in length of maturity, more interest is demanded by the investors. Very slight amount because they're showing all kinds of terms here. But you can see we're all the way up to 1.63 on the 10-year. And then even the 20 and 30 require more. So we can go down here in 2022, and we can see that this yield curve was not inverted in the beginning of 2022. And we'll even get, let's get right here into March, and we can see that the 10-year was 1.7, 1.8. Let's head over to March of this year, and we have mortgage rates at 3.5, 3.8, almost 4%. So yeah, the mortgage rates were basically 2 percentage points above the 10-year. Okay, so this is a positive yield curve where the rates on the shorter end are less, rates on the longer end are higher. Okay, people have not been believing the Fed that they're going to raise interest rates. Yep, they have. Here's the short end going up. And here's the 10-year going up. You can see still a positive yield curve. Well, at some point here, the yield curve, once the Fed started upping more, people stopped believing that they were going to keep going and therefore pushed the rates down on the 10-year. Look at this. So started in the summer here, not too long ago, the 10-year started being below all these other terms, the 5-year, the 7-year, all of those, but not less than the 20 and the 30. Kind of interesting. It does seem like the 10-year is being manipulated some to create lower interest rates, because you'll see in some spots here, very interesting. Okay, the 7 years here, the 10 years here, and the 20 years there. Why is this the only one that's lower, right? You have to ask yourself. So the Fed is moving along up in these rates here. Looks like we're going to go to 3.25 this next meeting, but you can see how there's a lot of compression now. We got 2% on the low on the 1 month, 2 month, 3 month, and we have 3% on the 1 and 2 years, and still below 3% right here. Go to that August date. Something else I want to show you. So the 10-year has been around 2.6, 2.7, right? That was August. You go right here, and the mortgage rates were 4.99, and let's see, just want to move a couple days here. Oh, it goes week by week. And 5.3. You're like, wait a second, that's not 2 points anymore. 2 points on top of this, rates should have only been about 4.6, 4.7, Jason. You were just showing us that you take the 10-year and add 2 points to it. I was showing that what is the historical norm, and I'll explain that. So that is why we have people racing on our street now. So if you hear that noise, they race motorcycles and cars on the street. That there's a lot of side roads on. I find it very interesting that they'd risk that. And now you can even see it here. And most recently, look at this. We have the 3-year at 3.8, only 3.45 on the 10-year, and 3.8 on the 20-year. So now the 30 is actually dipping a tad, but I still find it interesting. The 10-year is the lowest of all of these. So now we're at 3.45 on the 10-year, and the mortgage rates are at 6.02. So you can see now that the margin between the 10-year and the 30-year mortgage has changed. And now you're going to find out the secret formula. So basically, the Fed funds rate is all that the Fed can affect. The 1 to 2 year, when you have a normal yield curve, which we will get back to, it requires less volatility and requires whatever the economic downturn to be more known. We don't have to be out of it, but the yield curve should start normalizing in the next year or two. And the 1 and 2 year usually trade at 50 basis points above, and the 10-year about 100 basis points or 1% above the federal funds rate. So let's hop over here again and see what those are. So the 2 year is over here at 4, okay? And the Fed funds rate, they're predicting 2.75 right now, but it's going to go up to 3.25. And let's just say we have 4 on the 2 year, okay? So right now, this is what's going to be happening this next week. We are going to have a Fed funds rate of 3.25%. The 2 year will not drop. I mean, there's always daily volatility, but it's already at 3.85, so it's going to go to 4. So it's a little more than this 50% basis. I should put in here that it's 50 to 75 basis points, but then we start having to look at too many numbers, right? And the 10-year is then X, the federal funds rate, plus 1. So let's come over here. So soon the 10-year will be 4.25%, whereas right now it's 3.45. Mortgage rates, my entire life that I've followed them for 30 years, the premium that investors have required over a 10-year treasury, because that's what they compare it to. So the Fed can only affect this number here. And then these kind of play off of it depending on the economic terms, the trust in the government, and things of that sort. So mortgages, when times are calm and things are steady and the economy is doing fine, they generally trade at 2% over the 10-year, which I just showed you in 2020 and 2021. That's exactly, you could just take the 10-year, add 2 percentage points to it, and you got the mortgage rates. In volatile times, investors are going to require 2.75, maybe 2.5 over the 10-year, depending on how volatile they are. If lending is being constricted, this happened in 2008, 9, and 10. As the lender started falling and things started getting riskier, the margin that they wanted, because homes weren't as safe in that economy, so this margin goes up. And this is why I knew interest rates were going to go up significantly when Jerome Powell announced this, because we were already trading at the low margin. We had a 10-year that was barely above the 1-year and 2-year. So we had a compressed margin here in 2020 and 2021 and a compressed margin here. That's how we are getting the rates under 3%. As you can see, even in normal times, if the Fed funds rate goes to 0 again, can't see that happening anytime soon, but even under calm times, you'd have a 1% premium on the 10-year and a 2% on a mortgage. So it's almost impossible for interest rates to get back down to 3%. It would require everything to be great, calm, and the Fed to be down to 0. So let's talk about where we're probably really going long term. Let's say the Fed goes to 4 in the next few months and probably analyzes the situation at that point. Can't really make any predictions beyond that. We're going to be then looking at X plus 1. We're going to be looking at 5% on a 10-year. We know mortgages have higher risk than a 10-year treasury. And in my last video, I showed you how a mortgage is valued based on what the interest rate is. So we know that we're not going to be in calm times in a few months. We're going to have some volatility. So in all likelihood, the mortgage rate will be somewhere between 7.5% and 7.75%, a 2.5 to 2.75 margin on top of the 10-year. So this is how you can predict rates, guys. That's just how they're calculated today. Right now, we have a 3.45 10-year, and if you add 2.6 to it, a margin, you get the current mortgage rates of 6.05, 6.1. I'm seeing more around 6.1, 6.2. But the yield curve will normalize. That is what people are not aware of. These rates will trade higher than the federal funds rate, and then you've got the premium for a mortgage. I don't want to really go. You can see how things could get out of hand if this goes to 5, right? And this goes to 6, and things are really scary. Massive high inflation. The mortgage companies are going to want a 2.75 premium. I'm not saying we're going there, but it has a very good possibility that this is where mortgage rates could be. So everybody's kidding themselves when they think they're going to come back down to 5 and 4. It's just not even a possibility. I mean, the Fed generally likes to hold the federal funds rate around 2. They only drop it to 0 when they try to just goose the crap out of something collapsing, right? So if things normalize and they drop it back to 2, then we'd have a 3% on the 10-year, and then would still be at 5 to 5.75 on mortgages. So best case scenario, we're going to see 5s again in the mortgages, which is where we're at. And worst case, this. So there's your little formula, Fed funds rate plus 1% for the 10-year. All you have to do is really follow the 10-year. But I already know if they were to halt raising rates right now, the 10-year will get ahead of the Fed funds rate by that amount. So, and then you add on, right now we're in volatile times. So that's where we're at, guys. That's how you calculate future mortgage rates and plan accordingly. If you know for a fact you're going to have to borrow money in the next few years, I'm not saying overpay for something, but if you know you're going to have to borrow money, would you rather borrow it today at 6% or possibly pay this in the future? All right. Thanks. Comment below. Give me a like and a subscribe. And you can always reach out to me too. I love talking this. This is my line of work. It's my business. And I'm going to have some more great videos coming out for you guys. Take care.